Hello, a very warm welcome to all of you. Today we are going to discuss about a concept that has been eluding the financial accountants in schools for a long time now. We are going to discuss about the development fees in schools, its accounting, and various compliances that need to be followed. This video has been brought to you by Equity India Financial Service. I'm Anuj Mahajan, the founding partner at Equity. This has been prepared under the guidance of CA Shri N.K. Mahajan, who has been in this industry for the past 40 years, and we would like to extend our heartfelt thanks to him for his valuable inputs. So this video is going to be divided into the following topics. We are going to start with the concept of development fees and the various preconditions that need to be followed. Then we are going to discuss about the various funds that need to be maintained. Then we are going to discuss about a very important compliance, that is basically the para 99 compliance. Then we are going to discuss about the entire life cycle of an asset which you purchase out of a development fees. With the help of an illustration, we are going to start with the purchase of the asset. Then we are going to discuss about the useful life of it, and finally we are also going to tell you how to dispose of that asset. While discussing this part, we are going to answer a very sought after question, that how do we reduce the depreciation reserve fund account. So do stick with us till the end of this video in order to get answer to that. We're going to conclude this presentation with the common errors that people make while making alternate accounting treatments. So starting with the first topic, let's discuss about the concept of development fees. Now when you're talking about development fee, there are several preconditions for charging it. We have to always make sure that we are following fund-based accounting whenever we're talking about development fees. Whenever you're charging development fees, the amount that you collect during the year should not exceed 15% of your annual collection of tuition fees. Secondly, whatever you charge during the year, everything has to be treated as capital receipt. Whenever you're going to utilize this fees, it's always going to be for these three aspects, where it's going to be used for furniture, it's going to be used for fixtures, and it is going to be used for equipments. Any unutilized portion of development fees that remains at the end of the year, it has to be kept separately and it should not be used for any other purposes. And finally, the depreciation that you charge on development fees assets, whatever amount that you charge to the income expenditure account, you have to put the equivalent amount in the DRF fund account. Now moving on to the next topic, we are going to discuss the various funds that need to be maintained. As a lot of you might already be knowing, these are the three basic funds that need to be maintained. Development fund basically captures all the receipts that you receive during the year. Whatever amount you receive from the students, you properly credit it in a separate development fund bank account. Whatever amount remains unutilized at the end of the year, you maintain it in a fund and properly in its bank account. The utilized portion of the development fees is shown separately under the development fee utilization fund account. And the third fund, the depreciation reserve fund, basically is equivalent to the amount of depreciation that you charged in the income expenditure account. Please note that all these funds are restricted funds and their utilization has to be for a particular purpose. The particular purpose in this case is the purchase of furniture, fixture and equipment. Next, we move on to a very important compliance in regard to development fees, which is basically the para 99 compliance. So ICAI in 2005 issued a guidance note for accounting by schools, and in that guidance note it gave a lot of suggestions as to how the development fund accounting needs to be done. So if you look at the entire para, so this is the entire text for that. Now what we're going to do is we're going to mark out the relevant part for us, and what we're going to do is we are going to highlight that. So restricted funds that are meant for meeting the capital expenditure, which is basically the development fund in our case. So we are going to mark out that so that we can just focus on this part and we can just ignore the remaining. So you can just read along as this gets marked, because it's very important that we understand each and every word properly and we read it in entirety, because what we have observed is whenever people are making errors in this, they usually do it because they don't read it completely. So this is the entire part which is relevant for us. So let's just erase the remaining part from here, and now let's just try to read it word by word and try to fit it in our balance sheet. So this is what our balance sheet looks like. So there are assets on the right hand side and there are liabilities on the left hand side. You have a general fund and you have a corresponding bank account for general fund. You have a fixed asset schedule for development fees and assets and for the normal assets. So let's start with this. So para 99 starts with where the fund is meant for meeting capital expenditure. So this is basically the development fund that it talks about, that wherever the fund is. So development fund, as you know, is meant for meeting the capital expenditure for furniture, fixtures and equipments. So this is talking about that. Then it says upon incurrence of the expenditure, the relevant asset account is debited. So when it says that the relevant asset account, it is basically talking about the fixed asset schedule for the development fees asset. So whenever you're going to purchase an asset, you're going to debit that part of the balance sheet. Then it says whenever, so it reads that upon incurrence of the expenditure, the relevant asset account is debited. Next, it says that the concerned restricted fund account is treated as deferred income to the extent of cost of asset. So it says that whatever amount you have used for the purchase of asset, you should treat it as a deferred income. So what we do is we just move out the amount that you have used for the purchase of asset and you write it as deferred income. Next, the para says that and is transferred to the credit of income expenditure account in proportion to the depreciation charged every year. So it says that whatever amount you're going to charge in the income expenditure in the form of depreciation on the asset, you need to transfer it to the credit of the income expenditure account. Now this is where a lot of people make error, because they are just reading the plain words of it and they are not reading this statute in entirety. What people fail to read is that when it talks about the crediting of the income expenditure account, it says so to be shown in the restricted funds column. So read the parenthesis closely. What it says is both the income so transferred and the depreciation should be shown in the restricted funds column. So it says that the income so transferred, so basically the deferred income, and the depreciation, so it says about the credit entry of the depreciation, both of them have to be shown under the restricted funds column. If you're going to credit that in the general fund, that is basically an unrestricted fund. So para 99 clearly says that the credit entry has to be done under a restricted funds column. So what we're going to do is we're going to just erase it from there and we're going to just put it here. So this is what the para 99 word by word analysis looks like, that we have a general fund which is under unrestricted funds, and then we have a deferred income fund, and then we have a credit entry of that is equivalent to the depreciation that you have charged in general fund. So now let's do one thing. We're going to reclassify some of the funds. The deferred income fund that we had made earlier, we're going to call it as the development fee utilization fund, and the credit entry that we have done earlier, we're going to just reclassify it as the depreciation reserve funds account. Once you do this, this is what my final balance sheet looks like, which is fully compliant to para 99, and as we've already explained the definitions of each and every fund earlier, so this is what we are going to work with in the subsequent slides now. Moving on, now we are going to discuss about the asset life cycle, how an asset is purchased out of development fees, how it varies year to year during its useful life, and how it is going to be disposed of finally. So coming to the purchase of the transaction, we started with an illustration, and we are going to take some basic assumptions here. So let's say we're going to purchase a computer from development fees, and let's say that it is going to cost us about 40,000 rupees. Useful life, we are going to assume it at 3 years. So we are going to assume that after 3 years we are going to dispose it. The depreciation rate that we are going to assume here is 40%, and the final value, the final salvage value at the end of its useful life, we're going to assume that we're going to just get $1,000 for it. So 1,000 rupees of salvage value at the end of the useful life of the asset. So let us now just try to put these numbers into the balance sheet that we had just seen, and let's see how it impacts each and every section of that balance sheet. So this is the balance sheet that we had seen in our last section. Let's assume that we collect 3 lakh rupees from the students during the year, and for simplicity purposes, let's assume that we do not have any other assets till now. And similarly, we are assuming that there are no assets from development fees as well, so it's also going to be at 0 level. Now since there are no assets from development fees, so obviously there's not going to be any depreciation reserve fund also corresponding to that, so it's going to be at zero level, both its bank account as well as the fund. And as we had seen in our preconditions section that the development fee collection is about 15%. So let's say if the 3 lakh was the tuition fees collection during the year, so let's assume that 15% of that is 45,000. So we have collected 45,000 rupees of development fund during the year. So it brings us to the final balance sheet size of 3,45,000. Now we are going to purchase the computer that we had assumed. So as soon as you purchase a computer of 40,000, you are going to write a check from the development fund bank account, and the balance of that bank account is going to reduce to 5,000. A corresponding debit entry is going to be made in the development fund as well. So both the fund as well as its bank account is going to be at 5,000 rupee level now. As soon as you purchase the asset, the fixed asset schedule of the development fees assets is going to increase by 40,000. And similarly on the left hand side, the development fee utilization fund, so that is basically the utilized part of development fees, that is going to be at 40,000. Now let's come to the end of the year, end of the first year, and as soon as the year ends, we are going to charge the depreciation on this computer. So as it was a 40,000 rupees computer, a 40% depreciation rate on that translates to about 16,000 rupees of depreciation. So we're going to charge that depreciation to the general fund as given in the DOE orders. So as soon as you charge 16,000 rupees to the general fund reduces to 2,84,000 rupees. As soon as you charge it to the general fund, you're going to move the same amount to the DRF. So the DRF increases by 16,000. What we need to note over here is that this depreciation that we're charging to the general fund, that is a non-cash expense. So a lot of people come to us and they ask us that sir, we do not have any funds in our DRF bank account which we can use for future contingencies. What we need to note over here is that the 16,000 that you have charged in the general fund, there is no actual cash expense that you have incurred for it. This is just an accounting entry that you have done. So the actual amount corresponding to this 16,000, you still have that in the general fund bank account. So you haven't actually expensed it off, as it is a non-cash expense. So that is why what you see over here is that the general fund on the left hand side is at 2,84,000 rupees. However, the bank account of the general fund, it is still at 3 lakh because you haven't actually expensed off that 16,000 rupees. What we are going to do now is that since we have to follow the principles of fund based accounting, we are going to transfer balance of rupees 16,000 from general fund bank account to the DRF bank account. So this is going to be moved here, and the DRF bank account is going to be increased by 16,000 rupees. What effectively we have done here is that we have restricted 16,000 rupees from the general fund bank account, and we have put it separately in the DRF bank account, and this amount we have put for the future contingencies. So this is how my final balance sheet looks like at the end of the year. So if you notice the final figures at the end of the first year, you can note the color coding of the ovals that we have marked here. So every fund on the left hand side matches with its corresponding bank account on the right hand side. So first of all, if you look at the general fund, so that's at 2,84,000 rupees, and the bank account also is at the same level. Similarly, the development fund, if you look at it, it's at 5,000 and the bank account is also at 5,000. The development fund fee utilization fund account, that is at 40,000, and correspondingly the fixed asset schedule is at 40,000. And finally the DRF fund that you can see here is at 16,000, and correspondingly the bank account is also at 16,000. So the fund based accounting principles are being completely followed till now, and the total assets and the total liability size, if you look at it, it is still at 3,45,000. This is the same amount that we had started with. So there is no outflow from the balance sheet, so the balance sheet size still remains the same at the end of the first year. Now let's move on to the useful life of this asset. So we are already done with the first year of the asset, and now we are going to discuss how the asset looks like at the end of the second year and at the end of the third year. So first we look at the end of the second year figures, and we look here that again the general fund and its bank account matches. So basically the impact on general fund in this year is going to be of the depreciation that's going to be charged on the computer that we had purchased. For simplicity purposes, what we have assumed here is that there are no asset purchases, there is no other fee collection that has been done, so that we can clearly see which all places does this depreciation hit on our balance sheet. So if you see, the general fund has reduced by the yearly depreciation, and it's now standing at 2,74,400, and the similar amount is going to stand at the right hand side also. Similarly, the development fund, since we have assumed that there's no new asset purchase or no new collections, so it still stands at 5,000 rupees. The development fee utilization fund stands at 40,000 as it was at the end of the first year. And the DRF would capture the accumulated depreciation on this computer. So at the end of the second year, the accumulated depreciation would increase to 25,600 rupees. If you look at the total size of the balance sheet, it is still at 3,45,000. There is no change in the total size of the balance sheet at the end of the second year also. Moving on to the third year now. So at the end of the third year, again the general fund is going to be hit by the yearly depreciation on computer, and now the general fund would stand at 2,68,640 rupees. Same amount is going to be reflected in its bank account also. Again, we have assumed that there is no yearly fee collection of development fees, or there is no purchase of the asset from development fees, so it is going to stand at 5,000 rupees. Development fee utilization again stands at 40,000, and the DRF again would now reflect the accumulated depreciation till the end of the third year. So now the accumulated depreciation is at 31,360 rupees. So this is what my final third year end balance sheet looks like. Again, the size of the balance sheet still is at 3,45,000. There is no change at all in this, and if you see, all the principles of fund based accounting are still being followed. The funds exactly match with their corresponding bank accounts to the right hand side. Now we come to the very interesting part of it, and this is where a lot of people get confused. We believe that in real scenarios they are actually disposing of the assets in their schools. However, the problem is that they are not able to account for it properly. This might be due to the lack of the understanding of the concept. So we hope that this section is going to put some clarity in your minds on it. So while disposing of the asset, let us put some basic assumptions on it again. So let's assume that we are going to dispose the computer that we had purchased 3 years back, and the cost, as you had seen, is it was 40,000 rupees at the start of the purchase transaction. The accumulated depreciation from the last slide, we have seen that it was at 31,360 rupees, and let's assume that the salvage value that we are going to get, or the value that we are going to get by selling it off, let's say assume that we are going to get about $1,000 for it. So let us now just fit these figures and let's see how the balance sheet looks like. So this is what my balance sheet looked like at the end of the third year. So my general fund, my development fee utilization fund, the DRF, everything is at the same level as it was at the end of the third year. So we're going to sell off that asset, and as soon as you sell it, you're going to get 1,000 rupees, which you're going to deposit in your development fund bank account. So this is how the entries are going to be reflected on the balance sheet. The development fund will be increased by 1,000 rupees, and it will be at 6,000 rupees as soon as you put the figure in it. And similarly, the bank account is going to be increased by 1,000 rupees, and therefore the bank account will increase to 6,000 rupees. Now, since the asset is no longer there, so we are going to remove it from the fixed asset schedule also. So you see that the fixed asset schedule of development fee assets, it reduces back to 0. And since we have reduced the fixed asset schedule also, the development fee utilization fund is also come down to 0. So you see, this development fee utilization fund, as soon as you had purchased the asset, it increased by 40,000, and this is just a reverse entry of that. So as soon as you sell this asset, it has again come down to 0. So this is what my final balance sheet looks like. So your general fund still stands at the same level. However, the fixed asset schedule, if you look at, that has come down to 0, and similarly the development fee utilization fund has come down to 0, and the development fund has increased by 1,000 rupees. That is because you have deposited the 1000 rupees of salvage value in that fund and its corresponding bank account. So you see the total assets and the total liabilities have now actually come down. So earlier it was at 3,45,000, but now it stands at 3,06,000 rupees. So this is because you have written off 40,000 of 40,000 rupees of asset, but you have added back 1,000. So it translates to 3,06,000 of the balance sheet size now. So now once you've disposed that asset, obviously it's once that asset has been removed from the school balance sheet, obviously it will need a replacement, and this is precisely what the DRF comes in for. So DRF originally was proposed for meeting the future contingencies when you might not have funds for buying new assets, as we say that for meeting the designated purposes of purchasing the furniture, fixture and equipments. So this is precisely the stage that we have come at. You see the balance sheet. Now the development fund is at 6,000 rupees, but your DRF bank account holds 31,360. So this amount is the amount that you had restricted from the general fund bank account and moved down to the DRF bank account. So this fund is now going to be used for meeting my future contingency of replacing the old asset from the new asset. So this is the replacement illustration now we are coming at. So let's assume that the new asset they're going to purchase is again a computer, and let's assume that the cost of this new computer is going to cost us about 30,000. So earlier we had purchased it for 40,000. Let's assume that we're going to buy this different model now, and it's going to cost us just 30,000 rupees now. So let's just try to fit these figures in the balance sheet. So this is what the balance sheet looked like when we had disposed the asset. So we are standing at a 0 development fee utilization fund and development fee asset schedule, and my DRF bank account holds 31,360 rupees. So as soon as we are going to purchase the asset of 30,000 rupees, and we are going to purchase it from the DRF bank account. So as soon as you write a check from DRF bank account, what's going to happen is that it's going to reduce by 30,000, and the final bank account balance is going to come down to 1,360 rupees. Now the DRF fund is also going to come down, and it is going to come down to 1,360, similar to the value as is there in the bank account. Since you have purchased the asset, so the fee so the development fee fixed asset schedule is going to increase by 30,000 now, and correspondingly the development fee utilization fund, that's also going to increase by 30,000 rupees. So once you have done the purchase, this is what my final balance sheet looks like. Now my DRF bank account is at 1,360 rupees, which is the same amount as is reflected in the DRF fund. Your development fee asset schedule is at 30,000, and similarly the fee utilization fund balance is also at 30,000. The development fund stands at 6,000. We haven't changed that, so it still stands at 6,000, and the development fund bank account also remains at 6,000. So the final balance sheet size, if you look at it now, it's still at 3,06,000 rupees. So there's no extra infusion that had to be done, and that the sole reason for that was because we had reserved a part of the general fund for meeting my future contingencies in the form of DRF bank account. So this is what my final balance sheet looks like. Moving on, we come to the final part of this video now, and here we are going to discuss about the common errors that are usually made while making alternate accounting treatments. So one of the errors that we have seen very often being made by people is relating to the compliance of para 99. They credit the depreciation charge on development assets in the income expenditure account itself. So what they're doing is they are charging depreciation in the expenses side, and correspondingly they're making a contra entry to the income side of the income expenditure as well. So the biggest problem that is there in this entry or this credit entry in the income expenditure is that they're not reading the para 99 in entirety. Para 99 clearly says that the credit entry that has to be made, it has to be under a restricted fund account. So as soon as you're making a credit entry in the income expenditure account, that completely is contradictory to what the para 99 says, because income expenditure is a part of general fund, and general fund is an unrestricted fund. Para 99 clearly tells us to make that credit entry in a restricted funds account. So this is in complete violation to para 99 in fact, and the reason for making this error by so many people, the reason for that is because they're not reading it in entirety. In fact, they're not reading the parenthesis at all. And not only that, when they're making this entry, they're also violating a basic precondition of development fees, because what they're doing is, as soon as they're charging depreciation on the expense side and a contra entry to the income side, they're effectively negating the impact of the depreciation in the income expenditure account, and that is going to violate a very basic precondition of charging development fee. This error is easily avoidable, and it can be easily prevented by reading the para 99 much more carefully. Moving on, we are going to now discuss about another error that we have seen a lot of people making, and that is for the development fee utilization account. So what we've seen is that a lot of people debit the development fee utilization account and by the yearly depreciation that they charge on the development assets. So when they do this, what they're effectively doing is that they are maintaining the development fee utilization account at a net level or at the WDV of the assets purchased. Now this is clearly in violation of para 99. Para 99 in its text clearly says that the deferred income, so deferred income is what we had reclassified to development fee utilization account. So it clearly says that the deferred income has to be maintained to the extent of the cost of asset, and when we are saying the cost of asset, it means the gross level of the asset. So I think the operating words that need to be kept in mind in this case is that the cost of asset is equal to the gross level and not the net level of the asset. So that is another error that we have seen people making a lot of times. So this is all for now, and we hope that this video has been of some use to you, and it has helped you in removing some of the doubts that might be there in your minds regarding accounting the development fees and ensuring that you are fully complying with para 99. Do reach out to us in case you still have some doubts. We are leaving the contact details on the screen here, and now we hope to see you again in a subsequent video. So till then, have a good day, and thank you for watching this video.